Hello and welcome to the Harwood Report for April 9th, 2018, presented by Trade Academy. I am Keith Harwood, your host and the founder of Trade Academy. Standard disclosures, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Consult with a financial professional before executing any trades. So as usual, I'm going to go through the normal equity indices. It's been a lot of chop the last few weeks. I want to talk about what I'm seeing, what signals I'm starting to see maybe from the VIX here, maybe starting to change the tune of the market in spite of some of this news we've gotten on Chinese tariffs. Going into earnings season, that's going to have an impact on all of these indices, obviously. Let's talk a little bit about bonds and what they're looking like right now. Gold, there's been a lot of chatter from people talking about gold, getting a little bit bowled up on gold and silver. I'm going to take a look at that and I'll talk about where I lean on that equation. And of course, oil, just a whipsaw the last couple of days. A lot of stuff going on with Syria, Russia. That's going to have an impact on oil prices, which in turn will have an impact on oil companies. First things first, fear and greed is at 12 now. In the previous few weeks, there was no real good justification for a 4, 7, 9 fear level. Chinese tariffs may have finally been that element that justifies some extreme fear, and the market was less responsive to that final moment that maybe should justify some fear. So in my opinion, the market's starting to give us some signals that all that fear that was already being priced in may have been too much. Finally, they're starting to get that hint. Maybe this needs to come back up, unless something else comes out that drives us into a new bear market. So speaking of this, let's look at S&Ps. The two big days I really want to focus on are Wednesday and Friday. Wednesday had the announcement that China would basically respond to our tariffs. And everybody stepped it back and said, well, it's okay because we're going to just negotiate. And that had a massive rally. Wednesday, we said we'd maybe consider even more tariffs on China, and the market briefly breached the 200-day moving average, but held on the close. And then today we're rallying as the rhetoric gets lightened up a little bit. This chop is very hard for multiple day positioning, because as you can see, if I go out, a week ago, we were basically trading right here. Any trade in the options gets really hurt on a 1 week holding period, because if I'm short premium, short Estrella, short gamma, I'm getting stopped out of positions down here and back up here, and it's getting chopped up. If I'm long gamma, unless I'm actually trading it, hedging it, buying on dips and selling in rallies, I'm losing money because we net stay in the same position. And the market is starting to price some of that out via the VIX. So the guys that are short are losing money. The guys that are long are maybe losing money too in the options space. The VIX isn't spiking as much anymore. Friday's move below the 200-day moving average, I would have expected to see VIX at least up into this 25 level. Back to these levels. Getting ready for that potential for a move into the 40, 45, 50, because if we got much lower, the market had a serious problem. And yet, the peak on Friday was 23, and by the close, it was back to 21.5. And today, we're back at 21 and fading. At one point, we were down almost to 20. There's not a lot of fear being priced into the options. Why is fear not being priced into the options? Well, right now, that means that there's probably not a big long that needs to hedge. So when the market breaks and gets down near lows, what drives us lower and what drives up fear is somebody that says, if we get below this level, I'm getting out or I'm hedging. Well, nobody's hedging. And if this level held, there wasn't really a lot of selling, must not have been that much selling below to drive new lows. What this is telling me is that this market has cleaned out a lot of the weak hands. And weak hands are being driven every day. The buyer on Wednesday, on Thursday, stopped out on Friday, and he's getting back in today, and there's still some chop there. MACD cross, momentum is not there to the downside. I think this market really wants to find out what it feels like to be at the 100-day moving average again. Earnings this week may be the final driver to get us a little bit up there, and maybe, just maybe, the simplest part will be a lack of new fundamental input on the macro stuff. First things first, we got to take out Friday's high, 265.11. We get above that level, then I'm looking for 270. We can't take that out, and maybe our range is actually just going to be between the 200-day moving average and the 20-day moving average. So before, we were forming the wedge between the 200 and the 10, now 220. Then, as that tightens up too much, it becomes the 200 to the 50. You can see where I'm going here. If this 20 gets driven down too close to the 200-day moving average, well, now the wedge gets tighter there, and then we're looking for that breakout for that part of momentum. There's no momentum in the 10-day moving average. There's a downward momentum pressure from the 220. There's upward from the 200. We're in this little spot. And so if there's not a lot of people doing position, and it's really the 200-day moving average that becomes 100-day moving average that becomes you get from the 200 back up to from the 200 back up to the 100 and move forward from there. I don't want to trade that with options right now in the simplest senses. I'm not looking to buy calls unless we get above 265.11. I'm not looking to buy puts unless we get below 260. And if that happens and VIX is too high, I'm not looking to buy puts anyway. But I will show you the first trade that I would look at here, and I will be looking at it if we get above 265.11. So SPY has the benefit of having so many, so frequent of expirations that there's more we can do with them. I can look at Monday because that captures some of the first parts of earnings, captures the Friday boring, let's just rally the market mode. And if I'm looking for a move to 270, on a move through 265.11, simply look at buying a 268 call and selling a 270 call. And now it's about 55 cents. But on that rally into the end of the week, that could be worth about $2. So it goes from 53 to $2. That's a very good R&R. It's about as good of an R&R as I can get right now in the S&Ps because we're not to see a move above. I'm sorry, I need to see a move above 265.11, and then I can go look for that play. Next, let's go to small caps. Within the small caps, you know, they were a better performer for a little bit. They tested the 100-day moving average, pulled back, didn't get to the 200-day moving average, rallying now again. I mean, they're a little bit above on all these moving averages, right? So instead of being far from the 100-day moving average, we're close to the 100-day moving average. Instead of going below the 200-day moving average and closing just above, we closed well above. It does seem to still have a little bit of momentum its way. It's going to likely be the first to cross the 100-day moving average. So if S&Ps go to 270, that could drive IWM up to 156, 157. Makes for a more bullish setup. I'll talk more about how I'd like to trade that in premium putting out later today. That's the news. Let me go to the Qs. Let's close this here so that it stops. The Qs, I got the wrong letter. QQQ, not WWW. There we go. Qs held up better than the S&Ps, didn't get to the 200-day moving average, had tested the 100-day moving average much like IWM, but the other moving averages are a little higher. Those could create a little bit more resistance. The Qs have had a better performance today than IWM, catching up to the 100-day better, but I think that this probably doesn't necessarily get all the way up to, you know, near these recent highs of 171, but they should still perform better than S&Ps. So if S&Ps get to 270, the Qs are probably looking at 165, 166. I'm not sure if that's going to be the exact target, but I think that they have a better R&R overall. The question for me, if I'm trading the Qs versus IWM, is which one has cheaper vol. And I'll just show you here that 18 vol and the Qs have 24 vol. So IWM vol is cheaper. I can get more leverage out of IWM. That's the key for me. All right, let's move on here to bonds. They tried to set a new trend right in the 10-day moving average there. Broke way below it, recovered it. This is a moving market, which makes it a trading market. It's much like equities. The problem here is this doesn't seem to have a strong correlation. Like today, I would have thought that if with equity so strong, maybe we retest this 119, 120 level. And instead, we're sitting at 121. The big key with TLT is what I've been talking about for a few weeks, is that vol is still very cheap on a historical basis. It's about as low as it gets on a 6-month basis at 9.5%. So my simple trade here is similar to what I've been looking at before. We're trading 121 to 121 straddle for $2.95 makes some sense. It's not as theta intense, so if we sit for a couple of days, it doesn't hurt as bad. But if the market gets crazy, TLT vol should pick up. And if the market goes extremely bullish, TLT should find a direction, likely lower, getting away from that 121 strike. And in a bull market, if TLT gets down to, for equities and TLT gets back down to 118, that $3 straddle is still at least worth $3. If there's panic in the market that causes people to go straight risk off, we could see TLT back to 126 because they're not going to raise rates if the market is in free fall mode. That's where that straddle can really pay off for me. Metals. The dollar is still a trendless market. It is weak today. That has been what has gotten a little bit more excitement for the gold bulls. Dollar yen is a little weak today, but it's still sort of chopping higher, not chopping lower. Dollar yen is a better indicator of risk on versus risk off demand. So to me, even though it's a little weak today, this could be the move to fade in gold. Usually, when I've been looking at these on Mondays, dollar yen looks like it's changing its trend. Right there, March 29th. Let's see. So April 2nd looked like it was getting through a moving average. Then it just turns around on Tuesday. Kind of did the same thing here at the end of March. So right now, if fade the move on Monday is the play, then what's that mean? Fade the rally in gold. Gold should be moving back down towards 124, this previous low, if dollar yen does maintain its strength, if the dollar starts to show strength overall, if the dollar can find a trend. That would help get people that are only looking at this in dollar terms. Dollar yen is the one that I really want to see a trend, and that's starting to maybe form one here. Move above 107 again and start really pressing above the 50-day moving average, and that's going to give me my trend that gives me an indication that it's time for the short in gold. I'm close, but I'm not quite there. Silver, on the other hand, would be where I would like to be long, knowing that it's still kind of in that consolidation area. So this would be almost around where when gold was trading 124, silver was trading around here. So if dollar yen continues lower, I can play for silver to 16.5 pretty easily. But I need to find a trend in dollar yen before I get a lot of conviction in gold. Gold miners, of course, trade very similarly to silver, actually more than gold, and you can see that in the charts here. There's not a lot more to talk about here. I'll talk about these and the trade ideas around these in the newsletter again. What I will talk about here for you guys for one more trade idea is oil. So Friday had a big break in oil. I think all of these tariffs and everything started getting concerns about global trade, and we've got almost a full recovery of that today. Sitting back on the 20-day moving average really tells me that Friday's washout and today's recovery is putting oil right hand in hand with equities. But overall more bullish. We got down to the 50-day moving average, barely, not even to the 100-day moving average, and of course not down to the 200-day moving average. And XLE, on the other hand, has been stuck at the lows. It looks ready. It's finally crossing the 50-day moving average. Above us is the 100-day moving average. Below us is the 200-day moving average, right below us. If we can hold this, we can get one more push out of oil. That's when oil looks to go. But I've got to see us clear some of this last little bit of resistance here. OIH is further away. It is struggling because people are looking for the safer oil plays. So the first play in oil is to go through XLE, looking for a move initially above 69. And once that starts to clear, I'm looking for a move up towards 71, 72. So even though I think OIH vol is cheap relative to XLE, the immediate trade is in XLE. The catch-up trade will be in OIH. So if I miss it in XLE, I go to OIH because the vol's still cheap there. But in XLE, I'm looking for a move to 71 or 72, and I want to have a little bit of time and go to May 4th, give myself almost a month here. I can just do a very simple call spread again, the 70-72 call spread. 50 cents. If we go to 71, it's worth a buck. If we go to 72, it's worth 2. So if we hit my range, I'm going to make money. The problem, if I were to say buy the 71-72 call spread, is we could end up falling just at my long strike. That doesn't make me any money. If I go with the call spread, I'm really going to make money if the market rallies. All right, so that is it for today. The market find clarity and the VIX help it find clarity, but we're not quite in full clarity mode yet. A break below the 200-day moving average in SPY and a spike in VIX, and our clarity is that the market is in trouble. But if the VIX continues to fall and SPY retests this 100-day moving average, I think we're starting to find that, okay, we know where the real good support is and maybe start to consolidate around the 100-day moving average before finding our real trend. I do this part for free. I also have the newsletter that I've talked about a couple of times. I'll talk through some more ideas, talk through the setups, talk through how I'm looking for adjustments, and I'm going to give a Wednesday video update, or I do give a Wednesday video update only for subscribers. If you're interested, I can give you the first month for free. After that, it's $49 a month, so it's a pretty good deal. Go to tradeacademy.co, /Harwood Report to sign up. And you can always email me, keith@tradeacademy.co, or call me, 312-600-8004. Have a wonderful rest of your day, and I hope to see you all signing up for the newsletter this afternoon.